Hi, thanks so much for tuning in. You're watching the Mutual Fund Show on BK Prime. My name is Alex Matthew. As things stand at the end of market today, you have the Nifty 50 that's less than 2% away from all-time highs. And that's despite all of the headlines globally that are talking about a rating downgrade in the US, tensions in China with regard to growth. All of that, notwithstanding, the Indian equity market seems to be going from strength to strength. And if anything, the broader markets are doing even better than the benchmark. But the question is, for you as the long-term investor, is this the right opportunity to take some money off the table and look at your asset allocation? And to that end, should you consider hybrid mutual funds? What are the various options within this category? And should you, in fact, take that route? That's the focus of today's conversation. What are the advantages and disadvantages of taking that route? Joining me is Kshitiz Mahajan, who's Managing Partner and Chief Executive Officer of Complete Circle Wealth Solutions, as well as Kirtan Shah, who is the Managing Director, Private Wealth at Credence Family Office. Thank you so much, gentlemen, for taking the time. And I will start with you first, Kshitiz, just on the scenario right now. And the reason why I wanted to have this conversation is that a recent conversation I had with one of the guests on the show, Chief Executive Officer in the mutual fund space, and he himself said that if you've been in the investment cycle for a while, say about 5, 7, 10 years, you've accumulated a bit of a corpus, this might just be a good opportunity for you to rebalance. To that end, is hybrid the right route to take?
So, Alex, thank you. And hi, Kirtan. It's always a pleasure to be both of you on this show. So, coming back to what you asked, Alex, I think asset allocation is the key part which one should look at while rebalancing their portfolio. But not the reason that you have accumulated wealth over the last 7, 10 years, that's why we should do asset allocation. If it's debating a lot, let's say if it's 4, 5% from what you have decided, I strictly don't feel that that one should do asset allocation part. But yes, if it's debating more than 5% from the given part, so one should look at doing asset allocation. One should book some profits, or let's say if markets are not doing well, you're high on fixed income, then you move money towards equity side. But yes, at these levels, one should look at doing rebalancing of the portfolios. If you have more money which you can park on the fixed income side and again bring back your equity debt relation at the same combination, then there is no need for you to put or maybe book some money out of equities, because you asked me where I today to trading P on index only. It's not that the story is going to end or maybe a very big correction around the corner. But yes, if you are debating a lot from the given asset allocation percentage, let's say you are supposed to be 60% in equity and 40% in fixed income. Right now you are 70%, 75% equity because of market movement. Then one should look at adjusting by rebalancing its equity and fixed income allocation or gold allocation for that matter. And they can either take a route of putting money back in fixed income, or they can just move to a balanced advantage fund, which is a hybrid equity fund, as you mentioned. That can be a good idea. Where if you see that you can't navigate through these times and can't keep on doing asset allocation again and again, then give it to a fund manager or a fund house who has a good balanced advantage fund, depending on various other parameters. So that's a better way of doing it, because one, it is more tax efficient. Second, it will not consume your time, and it will not test your patience whether you want to book profits or not.
Very fair point. And in fact, those are the details that we're going to delve very deeply into, and I'm glad that you pointed that out. Kirtan, I'll throw that same question to you first, and then we'll go into the various options available in the hybrid category and which are the better ones to choose. So first, on that asset allocation part.
Alex, very honestly, I think as a retail investor, it is futile for you to try and time the market. For me, as a retail investor, it is not just getting your timing correct in terms of exiting, but I think it is more importantly, how and when will you come back. So while you try and time the market, you have to be right twice and not once. Most of us don't get it right even once. So even if, let's say, the markets are expensive and you think you want to really get out of equities and move to some other product, you might be able to do that, but you don't know when to come back. Will you come back 2% down or 5% down? Typically, we miss the bus, and by the time we really decide that we really want to come back to the equities market, markets have run away. So I think as a retail investor, you should definitely not try and time the market. even if the valuations are expensive, and if at all we have some discussion around that, I'll share a view on what I think of the valuations. But largely as a retail investor, I would definitely suggest not to try and time the market. Yes, if your allocation is way off, like Kshitiz was also saying, then try and rebalance it. Don't try and time the market, because you will never get it right.
Fantastic. Okay. But that still sets the context for this conversation. And Kshitiz, to a certain extent, was pointing out some of the advantages of going towards that hybrid route. But I want to just make this very clear at the start. There are various options, gentlemen, available under that hybrid category, but some are more tax efficient than others. And Kshitiz, you had started pointing this out because of certain changes that have taken place not too long back in the taxation of fixed income mutual fund schemes, or rather schemes with a certain allocation to equity below a certain threshold, right? Or rather above a certain threshold. So can you explain which of these hybrid schemes have a better tax efficiency? This is for you, Kshitiz.
Yeah. So, am I audible, Alex?
Yes.
So, Alex, yes. So, I'm saying, obviously, there's new regime is there on the fixed income side, what you spoke about, and a tax or full tax means that it's a part of your income, whatever you are generating as a return on the fixed income side. Second, I'm saying when you keep on shifting between equity and fixed income. So let's say market will move up again 8-10% from here. If it move up again, you do the reshuffling and the readjustment between equity and debt. It will not only create a short-term capital gain for equity as well as a capital gain for fixed income also. If you move from fixed income to equity also, I'm saying if you want to avoid that, then just taking what Kirtan has said, one can looking at a balanced fund category where the taxation part has been taken care by the fund itself, as 65% plus allocation is toward equities, and whatever you gain after 1 year is treated as a long-term capital gain. One is this. Second, it will save a lot on doing shifting between these funds by you, because nobody can get the timing right. So either you just keep on maintaining that allocation if it's not weighted much, or just look at a hybrid fund where the fund will do and make it more tax efficient for you.
Let's talk about the options available and why certain options are not as tax efficient as the others, Kirtan. So if you can break it down for us, what are the various options available in the hybrid category, and which have that equity taxation, which have the debt taxation?
So Alex, in the hybrid category in 2018, when SEBI came up with categorization, they split the category into 7 buckets. The first bucket is conservative hybrid fund, where the logic is that 10 to 25% of the investments will be in equity and equity related products, which is arbitrage, and the remaining 75 to 90% will be in debt. So conservative hybrid is a largely debt focused product. Then you have something called as balanced hybrid, where 40 to 60% can be in equities and 40 to 60% can be in fixed income. Now over here, the clear bifurcation is that you can't have arbitrage here. So the 40 to 60% that we are speaking about is going to be pure equities. The third category you have is aggressive hybrid. Like the name suggests, 65 to 80% is in equity and 20 to 30% is in fixed income. The fourth is the most popular amongst all of these categories, called the dynamic asset allocation or the balance advantage fund, where the fund manager can choose how much equity or debt that does she want in the portfolio, and looking at the market situation, they can keep readjusting and balancing the portfolio. The much newer category is the multi-asset allocation, where there are 3 asset classes in which you need to minimum invest 10% each. So there are funds who can be very extreme and different from each other. There are funds which can have 65% in equity, and then there are funds which can have 65% in fixed income also, because the regulation says you only need 10% in 3 different asset classes. Then there is simple pure arbitrage funds where you do arbitrage. And lastly is equity savings fund, where 65% of your investments have to be in equity or equity linked, which means arbitrage, and the remaining can be in fixed income. So there are these 7 different categories. Now, if I have to talk about specifics to do with taxation, let's break them down into 3, Alex. First is, which of these funds have equity taxation? Now, for us to understand equity taxation, we have to understand that the fund needs to have 65% of investments in equity or arbitrage. If they have 65% investments in equity or arbitrage, they'll be categorized as equity taxation. Now, there are 4 categories which fall into this taxation bracket: aggressive hybrid, BAF, arbitrage, and equity savings. These are the 4 which are taxed at equity level or taxation. Second is the old debt taxation, right? Which indexation advantage used to prevail before the 31st or 1st of April. There is one category in this space which is balanced hybrid, because this is for a category where you have more than 35% in equities. So balanced hybrid has more than 35% in equity. And any product which has less than 35% in equity will be charged as good as your fixed income or at your marginal slab rate, which is the last category, which is conservative hybrid. So 6 are divided amongst equity, old debt taxation, and tax like your FD. There is one category which is multi-asset. There is no real answer to this because, like I explained, it will depend whether you have more than 65% in equity, then equity taxation. If you have more than 35% in equity, then old debt taxation. But if you have less than 35% in equity, you will be charged like your FDs are charged. So multi-asset does not have one answer. That will depend on AMC's objectivity and how are they really doing asset allocation versus assets in the fund.
So for the purposes of this conversation, I would like to focus on the funds that have equity type taxation. And I believe that is effectively the more popular ones as well in the category. And I think both of you would like to talk about these as well. Now, having said that, let's establish one fact, Kshitiz. If you are going through this route, what is the kind of time frame that you should ideally keep when you say that you want to start? Say, suppose today I want to start an SIP into one of these, or I want to make a lump sum into one of these. What is the ideal time frame I should think of when I look at these schemes?
So 3 products falls into this category, and I will not suggest sit in any of the category. Arbitrage fund is there to park where you have money with the clear visibility of 3 months plus up to 1 year, or it's a little more over 1 year, because it is only by the arbitrage between what prices are here and in FNO. That's and it gives you edge of equity taxation because 65% plus is what they are selling is in equity markets. And then you have a hybrid equity, which is aggressive hybrid equity, which used to be your balance fund, which we used to call them earlier. And then you have balanced advantage fund. These 2 funds are there. So time frame for investing into these 2 funds should be not less than 2 to 3 years at least. In fact, at least 3 years. Because one is these are like balanced advantage fund is nothing but FD plus 2 to 3% return. Right now returns are looking very good across balanced advantage fund, but that's true for equity basket also. Equity, we say that is capable of generating 12-13% return, but right now returns are looking good because markets have done well. But yes, that's how balanced fund advantage fund should be seen as. And they have an equity taxation advantage also. So anything which is 1 year plus, and if you have a gain of 1 lakh plus, because 1 lakh is exempted, it will be taxed at 10% only. So at least 2 to 3 years is what you should look at for balanced advantage fund. Aggressive equity hybrid fund, which used to be balanced funds, one should look at 3 year plus time frame because they go up to as high as 65 to 75% or maybe up to 80% equity allocation in the scheme. So not less than 2 to 3 years for sure for BAF because that's the time frame one should look at. And sometimes what happens in a bull market, you see when market is moving up and valuations are high. So you see most of these BAFs are underperforming because they keep on maintaining a low equity. As and when market falls, they keep on stepping up the equity depending on various parameters what they work on. So 2 to 3 years for BAF and 3 year plus for equity hybrid.
Now, hypothetically, we're speaking one day ahead of the monetary policy where we hopefully will get some direction. But then I think broadly, fingers crossed, but Kirtan, broadly, I think there is consensus that states that we've reached the peak of the interest hiking cycle. Now, it is interesting because you've seen the bond yields move. Despite the fact that they went down to 7%, they've moved back up. I'm talking about the 10-year bond yield to around 7.2 or thereabouts, right? So a lot of people are talking about strategically, if you put money into fixed income right now, there is potential for capital gains over the next couple of years or whenever that cycle turns, because when interest rates go down, fixed income goes up, right? So from that perspective, as a strategic investment, would you say that it makes sense, considering that equity markets could move up from this point and you could also get capital appreciation from that fixed income portion of the hybrid category?
Share a very similar view. I think we also believe that interest rates have peaked out, and in our opinion, over the next 24 months, we should definitely see capital gains on the fixed income side of the portfolio. But I'll tell you the bigger problem with the BAF category is that on the fixed income side, there are funds who are very, very different from each other. Now, what do I mean is, if you look at the average category does not take credit risk, and the average category also does not take duration risk. So if you look at the average category fixed income portfolio, you will see, except one or two AMCs, there is hardly any AMC which takes credit risk, and there is hardly any AMC which takes duration risk. Why is this important to understand? Is because while you are expecting interest rates will peak out, and then when rates will go down, your fixed income side of the portfolio will make capital gains. These capital gains are only going to be visible if you are taking a duration risk on your portfolio, right? But that is not typically how BAF investments are done. BAF investments are largely done not taking the credit or not taking the duration risk. So I don't see that interest rates going down over the next 18-24 months will have any significant impact on the fixed income portfolio of BAF. But having said that, definitely it is going to be an added advantage, because if interest rates were flat or were going up, then the notional profit that you could have made on the fixed income portfolio would have been lost. So of course, from that perspective, it is only going to add more value. If interest rates fall, then the fixed income portfolio will slightly do better than you otherwise would have expected it to do. But I just want to put this point forward, saying that there's not going to be any significant impact of rates falling on the fixed income portfolio of BAF, because they don't take duration risk. But it is still better than what it is today.
So small angle that I guess, gentlemen, we have to consider is the post-tax angle, right? So hypothetically, if we invest today, and if we're investing a lump sum, and if we're doing investments into a hybrid category that hypothetically takes a 65% allocation towards equity, and therefore is equity taxation, I get 35% of my portfolio in fixed income, even if it does not take that 10-year horizon of fixed income. I still get a pop from the capital gains on that, and it's equity taxation. Kshitiz, is there a significant advantage to be had there?
Anyway, you asked me, and Kirtan put it very nicely, that let's say if you have right now on a short term paper 6.5 coupon coming on fixed income also, and you get a delta of, let's say, 40 to 50 bips, that means on a 35% allocation, or let's say 30% allocation, somewhere it is, you have arbitrage a little more, then in 30% allocation, it's straight to 1.5% jump on the yield if you get a 50% delta also. So, right now, good part is that there are good spread on the arbitrage side also. So you make annualized close to about 7.5-8% on arbitrage fund also. So that 30% right now, let's say, most of the BAFs are, if you say market names, are at between 42 to 45%, except for the Edelweiss, which is little above more than 50% in equity. But you see, you're making return on the equity side. Equity moves, and if it is falling, then you keep on adding money towards equity. You are making 7.5% on the fixed income arbitrage side, and then 6.5 to 7% on the fixed income side also. And that 6.5-7% is coming at a 10% gain only. And if you have a gain which is less than 1 lakh rupee on an annual basis, then it's always tax free to you. So yes, you're right, Alex. It adds a lot of weight to overall return, and it makes the fixed income return also tax friendly.
One last point before we talk about how to choose a fund. On the fixed income side, Kirtan, again, hypothetically from this point, based on everything that we know about monetary policy and where interest rates are, generally in a rising interest rate scenario, you need to be wary about capital losses on your fixed income portfolio. So from that perspective, that 35% of your portfolio is also protected, because we're unlikely to see capital losses on fixed income in the coming 2 years, correct?
Oh, 100%. There's no doubt about it. But there is another thought process to it, that if I'm let's say a conservative investor or a moderate investor who's looking at investing for less than 3 years, right? The call that I really have to take is that in the fixed income space, I'm largely confident that rates will fall over 24 months, right? And I am going to make the yield plus the capital gains, right? Though I'll have to pay slightly more tax for sure. But if I do the BAF angle, right, I am taking 40, 50, 60% exposure to equity also, which my risk profile might not be okay with. So I think while theoretically all of us are on the same page that as an aggressive investor, this makes a lot of sense because your equity, your fixed income, your taxation, everything falls in place for you. But that might not the case. That might not be the case for a conservative or probably a moderate risk investor, Alex.
Think of it from the perspective of whether or not you would shift out of equity into a hybrid rather than from a fixed income into a hybrid is, I think, the point that you want to make. Kirtan, correct me if I'm wrong.
Yeah, so I'm saying if I have to really, let's say, take a new bet today, right? And if I'm a conservative investor, I would rather do a fixed income because I know that over 18 months, interest rates are definitely going to fall. But when I do a hybrid, I'm taking 50% exposure to equity, which I'm not very comfortable with. And I don't know what will happen to equities over 18 months just to save tax, right? But if I'm an aggressive investor and I am feeling that probably markets are pretty much in a fair value zone and I don't see a lot of opportunity from here on, then I might as well want to book some profits out of equity and move to back temporarily. But not a conservative investor would want to do that, is my sense. As a conservative investor, I would want to stick to fixed income.
Point well made. Okay, point well made. And I think that kind of underlines the most important point, which I'm also taking from what Kirtan has said, is that don't make investments simply from the perspective of saving tax, because that's not going to achieve any purpose for you. Think about your objectives, think about your asset allocation strategy. Okay, so gentlemen, with all of those aspects that we've spoken about, setting the context for this leg of the conversation, how do you go about choosing the right scheme if you have decided to go towards a hybrid category? Kshitiz, I'll start with you.
So there are a lot of good options available, Alex. The good part about Indian mutual fund industry is that we have various funds available on various parameters. And these parameters ranges between price to earning, price to book value, dividend yield, trend ratio, interest rate scenario. So what we are talking about. So that's a new addition. What ICICI has started doing, they have added the interest rate scenario also. So depends on that, and one can actually choose between any of these funds. So I don't have personal liking about any single, but yes, ICICI BAF is one which is on P, price to book value and interest rate scenario. Then you have Kotak, which works on price to earning, price to book value and trend ratio. Then you have Tata, which is totally on price to earning only. So it's a defined parameter on which various companies work. Motilal has a BAF which works on price to earning, price to book value and dividend yield ratio also. So one can choose a couple of BAFs, and you really don't have to do any timing or STP or SAP in BAF. That's been done by the fund manager. Many of the people must be thinking that they're at the peak of the market, but that's the fund responsibility. Let's say if the peak of the market will not be the all-time high peak and there will be a new peak coming, then you lose a lot of opportunities. So don't sit outside. If you have decided to rebalance, then put choose any of these BAFs and do a lump sum investment. That's what my conclusion is.
No, important, which was the purpose of this conversation as well, right? Is that if you're uncomfortable with the equity markets at a certain level, don't book out and sit on the side. You book out and you redeploy into something like that. Anyway, so your point well taken, and I hope that the graphics played out on screen, because we did ask you ahead of time to give us your or the schemes that you've looked at. And very important, I think, viewers to pay attention to the kind of strategy that each of these funds employ, and that I think was elucidated in the graphic as well. But Kirtan, coming to you, do you have any picks in this space, and how do you go about choosing the right fund?
Alex, I think the purpose of building a portfolio is to diversify, right? You don't want to put in a lot of funds in place with different AMC names and just assume that you are diversifying. So with that thought in mind, we work with two funds, right? And we think these two funds together put a brilliant diversified portfolio ahead of us. One is ICICI BAF and another is Edelweiss BAF. And I'll give you a reason why this as a combination works out really well for us, right? you have equity and you have debt, right? Now you look at the equity component of ICICI, they follow the value style of investing. You look at the equity component of Edelweiss, they follow the momentum style of investing. So I have diversification on the equity side of portfolio. You look at fixed income side of portfolio of ICICI, they take credit risk. And you look at fixed income side of portfolio of Edelweiss, they don't take credit risk, but they will have a slightly higher duration, which takes interest rate risk. Now, if I have to marry both of these, then I'm having the best of 4 worlds put together: value style of investing, momentum style of investing, a little bit of credit, a little bit of duration. And hence, I think if anybody wants to park money in BAF, a combination of both of these funds will really do well in my opinion.
Fantastic. I think we've covered all of the bases. Gentlemen, always a pleasure speaking with both of you. Thank you so much for taking the time and for speaking to BQ Prime.
Thank you, Alex.
Thank you so much.
Thank you.
All right. Well, then viewers, we've got quite a lot of your questions answered, I hope, on the hybrid category and also the strategy that you might want to employ. If you do, in fact, feel that the equity markets are overvalued. That, of course, is a conversation that we have on a regular basis. And I would encourage you to stay tuned to BQ Prime to catch a look at that. Thanks so much for watching. This is BQ Prime.